Welcome to this lecture on disruptive models in the fintech marketplace, where we map how decentralized finance, embedded finance, and AI-driven analytics reshape traditional banking. In the next slides, we will explore the future marketplace ecosystem, highlight key business models, and show how modular tech and data orchestration create new paths for growth and customer value in financial services. This slide lays out a repeatable scaling pattern that fintechs use to grow rapidly without gutting incumbents. Think of a virtuous cycle: unlock new supply, bundle complementary demand, side services, aggregate idle capacity, and wrap interactions in programmable trust via smart contracts, which together accelerate scaling while preserving incumbent revenue pools and enabling coexistence rather than outright cannibalization. Here we examine the Robin Hood effect as a playbook for resegmenting capital markets. Commission-free, gamified apps focus on user acquisition and engagement, monetize through payment for order flow and market impact, and force incumbents to drop fees. The real insight is how price anchoring plus social UX can reshape audience segments and create a new user base around accessibility and community. Buy now, pay later transforms point-of-sale credit by embedding installment lending directly into merchant carts, using real-time SKU-level underwriting to assess risk instantly and deliver friction-free consumer credit. This model shifts underwriting from borrower-centric scores to product and transaction signals, enabling instant approvals, higher conversion at checkout, and seamless financing that merchants and consumers both prefer. Marketplace lending evolves by combining algorithm-scored borrowers with diversified investor capital, cutting branch overhead through a platform model. Early retail funding often seeds loan supply, but over time funding migrates to institutions, so sustainable platforms adopt hybrid sourcing. The core lesson is balancing scale with funding resilience to maintain loan supply as retail appetite wanes and institutional participation grows. Legacy banking stacks are often tangled, slowing innovation, while greenfield omni-stacks embrace microservices, API coverage, and public cloud elastic scaling to speed product launches. By running parallel modular systems, firms reduce complexity and time to market, enabling cards, loans, and deposits to interoperate flexibly and scale elastically, without the drag of monolithic cores or vendor spaghetti. Chime's approach shows how customer-centric simplicity attracts underserved consumers. No fee debit, early paycheck access, and built-in autosave features focus on everyday needs. Revenue is generated through interchange fees and partner incentives rather than overdraft penalties. And by removing branch and real estate costs, Chime scales deposits efficiently, turning accessibility and simplicity into a sustainable growth model. Wise exposes hidden bank spreads and replaces opaque FX with real mid-market rates and fixed upfront fees, creating a transparency engine that builds trust. Multi-currency accounts let users accumulate low-cost float, and that transparency becomes a trust asset that accelerates cross-border volume. The outcome is fast global reach across many countries and currencies driven by clear pricing and scale. Brex demonstrates how niche risk models unlock underserved segments by eliminating reliance on FICO and personal guarantees, and instead leveraging real-time cash flow and platform data. Focused underwriting for targeted SaaS and e-commerce customers enables instant limits and access, turning previously excluded firms into eligible borrowers and creating a competitive advantage through tailored, data-driven risk models. Banks facing disruption must modularize legacy cores, adopt cloud-native architecture, and build open API ecosystems that let them craft life event product bundles. The strategic imperative is to enable rapid iteration within secure sandboxes, preserve regulated trust, and stay nimble against attackers. Combining modular components with resilient cloud infrastructure protects incumbents while enabling faster product experimentation. Regulation is a powerful force shaping fintech disruption, with open banking APIs, BMPL oversight, and crypto rules, driving requirements around data, portability, capital, and disclosure norms. These impact areas create both friction and opportunity. and adaptive compliance, turning regulatory constraints into defensive moats, becomes a core competitive advantage for firms that can move fast while maintaining trust. Finally, the market converges around invisible, contextual financial products delivered where consumers already live and work. Embedded finance, tokenized deposits, and AI-driven orchestration create seamless offerings at points of non-financial activity, and winners will combine modular technology, trust wrappers, and ecosystem partnerships to deliver contextual value and capture new demand across every customer journey.